If you were born 5 minutes later, your entire financial life could look different. Not because you worked less, not because you made worse decisions, but because you entered a system that had already decided who gets rich first. And once you see how that system works, it's hard to unsee. Right now, it feels like wealth is about effort, skill, maybe a bit of luck. Study hard, work smart, invest early, build something valuable. That's the story. But beneath that story, there's a sequence, an order, a pipeline. And that pipeline decides who touches money first and who gets what's left over. This matters more today than ever, because we're living through one of the largest financial shifts in modern history. Trillions of dollars are being created, moved, and allocated. Markets are rising, falling, rebalancing, and most people are reacting to it, not participating in it. So the real question isn't how do you get rich? It's when does money reach you? Because by the time it does, it might already be too late. Let's start at the top. New money doesn't appear in your bank account. It doesn't show up in your paycheck, and it definitely doesn't start with small businesses. It starts in a very specific place: central banks. When an economy slows down, or when a crisis hits, central banks step in. They lower interest rates, they inject liquidity, they create money. Not physically, digitally. Numbers on a screen, but those numbers are real enough to move markets. Now here's the part that most people miss. That money doesn't get distributed equally. It doesn't spread out across the economy like water filling a glass. It moves in a sequence. First stop, major financial institutions. Large banks, investment firms, asset managers. They get access to capital early, cheap capital. Then comes the second layer, corporations. Large companies with strong credit, the ones that can borrow at low interest rates, sometimes close to zero. And what do they do with that money? They don't just build factories or hire workers, they buy assets. They buy back their own stock, they acquire competitors. And asset prices begin to rise. Stocks go up, real estate goes up, even speculative assets start moving. Now we reach the third layer, high net worth individuals. Investors who are already in the market. They benefit next because they already own the assets that are rising. They don't need to wait. They don't need approval. They're already positioned. And by the time we get to the fourth layer, that's where most people are. Workers, salaried employees, small business owners. This is where the system slows down because money doesn't reach here directly. It trickles in through wages, contracts, or delayed economic activity. But by the time it arrives, prices have already moved. This is the hidden system. It's not about who works hardest. It's about who receives money first. Because the first receivers get to buy assets before prices rise, the last receivers pay higher prices with the same or slower growing income. That gap is where wealth is created, and also where inequality quietly expands. Let's make this more concrete. Imagine two people. One has access to cheap credit early, the other earns a stable salary. New money enters the system. The first person borrows at low interest and buys assets, stocks, property, maybe both. Prices rise. The second person sees those same assets getting more expensive, but their income hasn't changed yet. They wait, they save, they
Through
try
this
to
process,
catch up.
we can see how easily digital creation translates directly into generating significant wealth.
Again, over years, over decades. The result isn't random. It's structural. And here's the uncomfortable part. The system isn't broken. It's working exactly as designed. Because from a policy perspective, the goal isn't fairness. The goal is stability. When central banks inject money, they need it to move quickly. They need markets to respond. They need confidence to return. And the fastest way to do that is through existing financial channels. Large institutions, big corporations, asset markets. That's the most efficient path. But efficiency has a side effect. It creates a timing advantage. And that timing advantage compounds. Now let's contrast this with the public narrative. You'll hear things like, invest early, make your money work for you. Anyone can build wealth with the right mindset. And technically, that's not wrong, but it's incomplete because it assumes everyone enters the system at the same point. They don't. Some people enter at the beginning of the pipeline, others enter at the end. And the difference between those two positions is massive. It's the difference between buying before a wave and chasing it after it peaks. There's also something else happening. As asset prices rise faster than wages, ownership becomes harder. Homes become less affordable. Stocks feel more expensive. Opportunities feel out of reach. So people turn to alternatives, leverage, riskier investments, short-term speculation. Not because they want to gamble, but because the traditional path feels too slow. And this introduces a second layer of risk, because now the people who are last in line are also taking the most risk, while those at the front are benefiting from the safest conditions. That inversion is subtle, but it changes everything. Now zoom out. This system doesn't just operate in one country, it's global. Capital flows across borders. Central bank decisions ripple through entire regions. Currencies shift, markets react, and the same sequence repeats. Money enters at the top, moves through financial channels, reaches people last. Each cycle widening the gap just a little more. Not dramatically, not overnight, but consistently. And consistency is what builds long-term outcomes. Now, here's where it gets interesting. Technology was supposed to flatten this system, make access easier, democratize investing, open up opportunities. And in some ways, it did. More people can invest today than ever before. But access alone doesn't change timing. You can enter the market, you can buy assets, but if you're still entering after prices have already moved, the advantage isn't the same. So the system adapts. It becomes more accessible on the surface, but the underlying sequence remains. First receivers, then everyone else. And the gap continues. So where does this leave us? It doesn't mean individuals are powerless. It doesn't mean effort doesn't matter. But it does mean the playing field isn't neutral. It's structured. And once you understand that structure, you start asking different questions. Not what should I buy, but when does money enter the system and where am I in that flow? Because that determines more than most people realize. It shapes prices, opportunities, even risk. And maybe the most important part, it reshapes how we think about wealth itself. Not as something purely earned, but something partially positioned. Positioned in time, positioned in sequence, positioned in a system that quietly decides who gets there first. So the next time you see markets rising or prices climbing, ask yourself one thing. Are you early in the flow of money or just watching it arrive after everything has already changed?